Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 7th, 2025. S&P 500 currently sitting at 5670. I'm David Zarling. I'm here with Ian McMillan. We've entered March Madness, Ian.
Feels like it.
Whether you're
Not a very good start to the month.
No,
I think it's not a terrible surprise, but here we are.
right. 2 weeks ago, we laid out the bearish thesis. We talked about the January low, the zero line, the election gap,
Yeah,
and a 200-day moving average. And here we are.
below all of
Below
them.
those levels in something like the S&P 500. I think you highlighted that, whether it's online or in our internal chats, small caps already below a 200-day, NASDAQ below a 200-day. And here we're on I don't want to use too much of an outlandish term, but S&P 500 below a 200-day. It brings up the old adage of Paul Tudor Jones, one of the best investors of our lifetime. Nothing really good happens below a 200-day moving average.
Yeah. It's still upward sloping, but
And that's really important context for sure.
it is. I think it gives maybe a little bit likelihood that there's some type of recovery. But hey, I think it's a pretty clear line in the sand as well. It's been probably 16 months since we've really even had to talk about this. So, hey, it happens.
The last time the S&P 500 was at its 200-day moving average was in October and November of 2023.
That was quick.
You know-
Wasn't very. Yeah, we were down there for what, like 2 or 3 weeks below it.
Yeah, not even.
Not even. Right.
Like 1 week. 1 week. The NASDAQ last time it was at a 200-day was August of 2024. Small caps had a couple more visits along the 200-day. But your point is valid. We're below the past 200 days of information, and that should pique our interest. Now, we're only 6% off the highs, but there are some pieces of information that actually, in some ways, remind me a little bit of October of 2023. And I didn't tell you I was going to do this, but we had an episode from back then, and some of the information kind of feels similar to now. The fact that the rubber band is stretched.
It definitely is stretched. I think Dietrich had a good. At least short term, this will be the first streak of 7 straight days with at least a 1% move. I believe he said prior to the 2020 election. A lot of volatility. All of these. It's really been a kind of a waterfall. We've had one. Okay, we'll call it 2, quote unquote, green days. Those weren't really super impressive, not from like a candlestick standpoint.
I want to play
pretty constant selling.
Yeah, and I want to play you the clip from back then because I think it mirrors a lot where we're at right now.
Okay.
And it's not a guarantee that we're going to have the same outcome, because right after that rubber band was stretched back then, it came back to its resting state. We had breath thrusts and we moved higher. But I think it's worth playing to highlight just the environment that we're in. And when you think about seasonality, the weakness in this year from August, September, even part of October is normal. But you've also heard us talk about October being amplification month. And so we're right on that precipice, and I think we've described on here in the past, of a stretched rubber band. And there's really 2 outcomes for a stretched rubber band. It either snaps or it returns to its normal state. Its rest state is what I should say. This market, when you look at what's happening underneath the surface, these mega caps are either going to catch down, and that would be the rubber band snapping, right? You just have an acceleration to the downside, an amplification directionally to the downside, or this is the final flush in the final piece of October, which would be classic to see heading into November, December, January, February, March, and April, which are the best 6 months out of 12, that we see it rip higher from here. And so I wanted to cover that because we're kind of at that same precipice here. Like, we're either going to see the rubber band flush Like you're going to have this flushing where all correlations go to one and you see a big event of selling. It is interesting that we're in another month of seasonality, March. And, the phrase goes for October, it's buy in October and get yourself sober. I can't think of a lot of things that rhyme with March. I don't know if it's like buy stocks in March so you don't get parched. I don't know what it would be, but there's nothing that really rhymes with March. But seasonally speaking, we do have an environment, seasonally speaking, in March where we do tend to see lows in March in the second week. Time will tell, but we haven't seen in the current environment, we haven't seen a 90% down day yet. The VIX is elevated, but we haven't seen a really high move in the VIX, like a spike in the VIX. We haven't seen a jump in the put call ratio. Those are all things that I think we have to be aware of, that there could be, as we talked about last week, one more flush, one more move down. Because remember, leading into this, we had extreme bearish sentiment, like sentiment that usually you see off of market bottoms, like the bottom of the '08 crisis or the bottom during COVID. You see these huge spikes in bearish sentiment, and we have that already, but yet the positioning hasn't matched by fund managers, retail. It's an environment where you could see one more quick move down to get bearish positioning that then sets up the next leg higher. Time will tell.
I agree. One thing that's been interesting to me during this correction, so when we look back at so two things. So we're 12 days from all-time highs. Candles, I'm using candles and not calendar days. So about 8% off the highs in 12 days. The correction that you talked about from July 2023.
Yeah, the August, September, October correction.
12 days into that, we're down about half of this. That got a lot, and that ended up being a 10% correction. It took 65 calendar days, so about 3 months. I say 22 market days a month, rule of thumb. So basically 3 months to go down 10, 11%. Very orderly. We had some green weeks in there.
Right.
When you move to last July and August, so 15 bars, 9% correction, never really got that close to a 200 day. We had a little bit of a rally. So this one to me is different in that, it's been quicker. And two, there's been no gap downs yet. It's been a lot of opening higher and closing red.
Right.
I don't know. I don't think we've had or I guess we have had a gap. We had a gap on Tuesday. Now we went up and kind of filled it. Last August we had gaps to the downside. The summer before that, 2023, we had gaps that were not filled. I don't know. This one just seems more consistent's not the right word, but they're hammering it. Like right. Intraday, when you watch it, there aren't many intraday rallies. And when they try, it just gets slapped right down. And same with these, when we've opened green, they even tried to rally it today and put it all the way back down.
And each week kind of has this upside down V formation where we're red on Monday, have some positive price action Tuesday, Wednesday, Thursday.
Yeah.
And that characteristic really hasn't changed. So we'll see. Below a 200 day, you've already had breath weakness going into this. Now, to be fair, you still have some international strength.
Yeah, international. Gosh, some good spots in international over the last week.
You did a good job highlighting for clients in the most recent write-up that these rebounds in international on a relative basis, and now in some ways they're starting to look good on an absolute, getting above major highs, that this decade-long downtrend on a relative basis, this might be how you see that turn, but it's going to provide plenty of opportunity along the way. So We'll see.
And you got, VGK breaking out to highest level since '08. So it's a European ETF or a US ETF that tracks European stocks. But yeah, you had double-digit Poland, Spain, Germany, Finland, Austria, China, not European, but really strong runs out there. mean, pretty much everything in Europe up at least 5% over the last week. That VGK ETF itself up 7%. I mean, I give them not a lot of things in the US hitting all-time highs. So they do have that going for them. But yes, to your point, when we zoom out, like Dave said, we talked about with clients this week in the letter, do we want to start piling into European equities? I'm still not quite convinced of that.
Yeah, it's a pretty long-term downtrend. I will say a really good step one has been reclaiming, you look at something like VGK versus S&P or IEV versus S&P.
Yes.
Reclaiming the September 22 low is a really good start. Because typically, when you think about big baskets of stocks, it's not that easy to turn a big barge overnight. And so you typically see trend reversals that take time. And it's been a good start to the year for international. Does that continue? No one knows. If you were to start to turn the barge, might be what it starts to look like. Is the opportunity over? Absolutely not. Again, this is a decade-long downtrend in these areas.
Oof, yeah.
They've been opportunity costs since December of 2007.
You're not making that back in 2 months.
Right. We're talking about on a relative basis, IEV versus S&P is still down 75% from the December 07 high. So plenty of work to do. And typically turning the barge around takes time. And when I say time, I mean months to years. And is this the start of that? It absolutely could be. And if that's the case, it will provide opportunity for our clients in the coming months, for sure. But as far as grabbing a falling knife at the start of the year, that's not really good risk management. That's just taking a shot.
They are going up.
They're going up now. And it's good to see some of these on absolute basis.
It is.
IEV still has to clear its 2007 high. So if you think about that's 20 years of 0% return for European stocks. VGK is in the same situation. Whereas, when you look at a 2007 level in the S&P 500, the S&P is up 265%. So Europe had 0% return the last 20 years. The US had 265% return. For that relationship to change will take time. And if you were to kick it off, it might look like this. And that'd be great. If there's a differentiator in the coming years away from the S&P 500, selfishly, as a team that manages money, it'd be great to have that differentiation.
Agreed.
Time will tell.
I would love it. Definitely been the mega cap tech show for a while. And we're kind of seeing, right, the headwind that can become when those big names don't go up. Because while Russell has been terrible, we get that. But, equal weight S&P doing a little better over the last couple of weeks. And this is what happened in 2022. Tech led to the downside. So when that snowball can start going back down the hill, it is really tough to overcome.
Right.
And we know tech's looked, how bad has tech looked on a relative basis for a while? Ugh.
And that's a key piece of evidence, especially when you look at something like XLK versus the S&P. You have this relative formation that goes back to May of 2023. So 0% return for tech stocks versus the S&P since, that's a healthy almost 2-year consolidation. Now, if that breaks to the downside, if that confirms that was distribution, there's going to be problems with U.S. markets for sure.
Unless everything else is going to come to the rescue. And I don't know. I don't know if I see that happening.
Right. And there's some bifurcation here. There's, we talked about Europe, some parts of Asia being strong equity wise. So you can't sit here and say everything is risk off, but you can look at CCC credit spreads, which have been rising the last few weeks. You can look at something like junk bonds versus intermediate bonds, which I believe are below a 200-day moving average.
Yes, they are.
You can look at something like XLK, right? The largest weighting with the S&P has been now struggling for 2 years. Yes, it's been a nice return in the U.S. markets since late 2023. But here we are. And is this rotation in international? Is this Is international going to succumb to the same selling pressure, right? Correlations go to 1. And that's that flushing piece that you wonder is still on the table. Do you still have a scenario where correlations go to 1 and most things get sold in the next week? And then it's time for the market to start rising after that? Or it doesn't. That kicks off a new bear market. Time will tell. I mean, Ian, I really wish I knew this. I really wish I knew where US stocks would be 6 months from now, but I don't. All I can use is the process that we have. And one of those simple tools, if you're a client, you're very familiar with this, is if you've got a 5-day moving average of something like the S&P below a 200-day, time to park the car. You don't need to drive in the snowstorm. We'll protect client accounts. And maybe it's late October, November 23, where that happens for a week. You park the car for a week, and then it's springtime and you're out on the road again the following week. That could happen as well.
Happens.
Yep. And I do think it's interesting, the sustained selling that you were highlighting before since mid-February.
Yeah.
That we still haven't gotten that 80% downside day, 90% downside day. You still haven't gotten that.
I 100% agree. I think you mentioned earlier. I think even on Tuesday, there was like a ton of call buying. Can't get the put call ratio to spike. It is, kind of complacent out there. And there's some other metrics that show the opposite, like total put buying is at an all-time high, according to some research. And right, you still got the AAI bears and bulls spread, which we talked about last week. Now, while those surveys are typically contrarian signals, people did that survey started flipping pretty bearish like in 2007. Again, I'm not saying that's what's happening here, because certainly that survey has marked tons of intermediate and long-term bottoms over the last decade plus. But sometimes can be, and when I'm there, I typically see it as a contrarian signal. But people can be bearish early and be, right. We'll see.
Yeah, we will. We'll see where we end up, but it is interesting to have pretty big bellwether like the S&P negative on the year, below the January lows, below the election gap, currently sitting below a 200-day. Now we're quite a few hours from close. That could change. We could see it close back above a 200-day, and we look back at this episode and all the bearish signs were already there. And, to me, I guess in a perfect world, which we're not in, you'd see that capitulation event before we move higher. You'd see that throw the baby out with the bathwater, 90, 80% down days, maybe one or two of those.
Spike yet either.
Yeah, right. You'd see that VIX spike. You'd see put call. You brought up put volume, but you bring up a good point there. When you say put call ratio, that's a ratio. You could have record put buying, but that must mean if the put call ratio is muted, that the call buying is also large.
It is. And those metrics are always tough to me, because when they're it'll be some graph of nominal put buying going back to 2000. And that's always tough to me, because there's just constantly more money in the system.
Right.
Like that number is going to be, that number in 5 years will be even bigger. But that doesn't necessarily mean, right? If we put it in more context, like puts versus calls, and that ratio still hasn't, so that just means that there's also record call buying going on, apparently.
Right. And that's when the call buying is the part that's got to decrease. So we still have this environment where people say they're bearish, but haven't positionally expressed that. Because you would see a jump in the put call if the call buying stopped. And you would see capitulation and flight to cash. And maybe that's what this week will cause, or maybe it's next week, or maybe not at all. Maybe this is just a normal, right? Because we experience a 5% correction in something like the S&P 500 4 times a year on average.
Well, that's once a quarter.
Yep. And a 10% correction once per year. And I'll go back to, Ryan Dietrich's good at pointing this out. That's the price of admission. And another way to think about this is we all have a bias called loss aversion.
Yeah.
where losing $100 bill out of your wallet feels way worse than finding $100 bill sitting on the sidewalk.
Well, no, I think that's where your zero line, and it's fair. I mean, humans are gonna human. Like,
Right.
it's impossible. And I think this, I'll put it in the same category, like a high water mark. It's impossible to not have those thoughts and emotions. Now, how you handle them can be different. Whether it matters to you and your process can be different. But yeah, I mean, I think it's right. In February, usually, we just came off a big bull market. You've got bonus and tax refund season, likely some high water marks being hit here in early 2025. And those stick with people to say, well, a month ago, my account was at X and now it's at Y, and that's not fun. Or, well, God, I remember on December 31st where my account balance was, and gosh, we're over 2 months into the year and I'm negative? Screw this.
Right.
You know, those are real emotions. Whether they're part of a valid process is a different discussion. But I mean, to me, as someone who does this professionally, like, I'm aware of high water marks.
Right. And
Now,
you're describing high water marks.
Am I panicking because, oh, we're X% off it? No, because I understand how trends work. But they're still like, oh, yeah, quite a bit. We're off of that.
You're saying like a high watermark is, when you use that term, you're meaning like when someone looks at their balance and they're like, oh, I'm at the highest I've been. I'm at 500,000.
Or like, I remember in early January, I had 400,000 and now I'm down to 350.
Right. Or I'm,
so that 400 just sticks with people. I mean, you and I have both witnessed this for sure over our careers. Again, it's a very natural human emotion. But when things go up for 16 months and then it doesn't go up, maybe for multiple months, right? 2015, 2016, or you can go sideways for 2 years.
Yep.
And not really be in this terrible bear market scenario, but that 400 grand is just constantly stuck in the back of your mind until you get to 401 again.
Right. And that's a natural part of trends. And there's two things there. One would be, if you think about the two facts, the average annual return is 9%, which is the least likely scenario. So that a 9% return in the S&P 500 is defined by extremes. Like 1 year you'll have a 20% return, and another year you'll have like 3.
Yep.
The other thing that's can torment investors if they don't have a process is, if you do have a 10% correction once per year, think about that. You have to sit through minus 10 to get positive 9.
Or add up the fives, add up your 4 5s. You're in theory sitting through 20% worth of corrections to get 9.
Right. And that's the price of admission in an uptrend. Now, could this turn into a downtrend and we have to protect accounts? Absolutely. And that is something we stay disciplined to and will do. But volatility within uptrends, that's a attribute of markets. They just don't move in a straight line.
Never have.
And yeah, you can go months before the high water mark in the account is reclaimed.
Well, you said earlier, since the top in 07, since the top in 07, S&P's up 265%.
Right.
And what did that come with?
And that came with
a lot of crap.
Right. A lot of crap in between. You know, you had 2011, you had 2015, 16, you had 2018, you had the COVID crash in 2020, you had a 2-year bear market in 22, 23. We don't have to sit through all of those as part of our process, but it is a grander reminder that markets don't move in a straight line. They typically have 4 or 5%, 4 minus 5% corrections in a year, 1 10% correction in order to get your average return. And then I'll throw on top of that, when you look at durations of bull markets. So if we want to make the argument that we're, you know, in year 3 of a bull market, year 3 tends to be the choppiest.
Okay. That's good info. I did not know that.
Yeah, that tends to be your choppiest environment. And I know Grant Hawkridge did a nice job highlighting this, that year 3 is just different than years 1 and 2. Like, so while the bull market is relatively young, you have two scenarios. You've got this, we haven't tested the 200-day in a long time. And so here we are. That's perfectly normal. You have, I should say three things. You have February, March seasonality, which is typically negative going into the second week in March. And you have this third year of a bull market, which tends to be the choppiest.
Like a 3-year-old toddler. Because now they know how to walk. They know how to throw tantrums. Years 1 and 2, you're still crawling.
Yeah. Why do they call it the terrible twos? Has it been your experience that I think it's age 3?
I mean, I would say like, yeah, two or 3, probably more so 3. I can definitely tell, like, Connor was really good, but you can tell, like, our youngest, who's at 18 months right now, like, way more of a temper tantrum kid than our older one. I think it's going to be. So, I mean, year 3, and that makes sense looking back on, right? Because you had 2013, 2014, then you get 2015 into pain in the butt.
It's one of those maturity things for a bull market that you're going to have this type of scenario. And really when you are managing money or operating as an investor, you operate in a thesis, right? We highlighted the bearish thesis 2 weeks ago. You also operate in binary thinking. If this, then that. For example, if the 5-day is below a 200-day on a Friday, we protect. It's that simple. Is there a scenario where we get a flush in the market? What I mean by that is correlations go to 1, we get a quick move down that gets people really bearishly positioned, and that actually ends up being the fuel that leads us on to year 3 and 4 of a bull market. Also a scenario. Do we not get a flush and we move higher from here? Also a scenario. And so you have to have a plan. We can't predict these things. You have to have a plan for each of those scenarios. It's kind of like one of the valuable lessons of life is when I had the privilege of playing quarterback at a high school and college level is you might have a linebacker step up into the A gap being right between the center and the guard. Okay, I've seen this before. Could be a blitz. Like this linebacker could be coming on a blitz. That blitz could be purposeful directly, or it could allow an outside defensive end to stunt in. He's occupying alignment, or he could drop into coverage. So in my mind, pre-play, my pre-snap read, I have to understand the different outcomes of what that linebacker is going to do. Same thing in markets. What is our reaction to different scenarios that unfold? We have multiple scenarios on our hands currently. Uptrend is still there, but we're below some important levels like the 0 line, the election gap, the January low. That's information. And the 200-day, that's information. Characteristic change.
And it's not just the S&P, right? So NASDAQ below the 200-day, Russell's been there for a while. Dow might have gone and tested it. The Dow's held up. I mean, sure, at least it's still going to always beta index. Now, still, even with today's move lower, and of course, we're recording this, we've had some recovery.
Well, that's just it. We could be above the 200-day, but by the time this is edited out the door and the market's closed. And that's okay. That falls into one of those scenarios for the market is maybe today is the day where people get, we've had an uptick in, I could say I've gotten family texts about the market and being nervous about it. We've gotten client contact about being nervous about the market. So we're also aware of these external factors of like, oh, sentiment is pretty pessimistic here.
For an 8% correction.
Right. Which is perfectly normal. And so you
and doesn't it tell you, I mean, people are still so on edge.
Right.
Completely but we're just 2 years in. Like I get texts from friends, and I wouldn't say that they're constant. I've gotten them before, gotten them a little, the whole like, we're due for what? We had a bear market 2 years ago.
Right. And before that, we had a bear market 2 years before that.
2 years before that. And 2
years
a
bear market.
Like, yeah. It's the whole like we're due is so. And I get it. If I wasn't involved in markets, if I wasn't a trend follower, if I hadn't discovered technical analysis, I might be sucked into that mindset too. But we're 2 years into, going into year 3, when we know that bull markets last typically 6, 7, 8 years, and there's a little year or two in there that are pretty late.
And, we're coming off, those bear markets we just mentioned, 22, 23, that was one. 2020 was another one in 2018. Typically, you see a 20% correction or more every 4 years, and that was 3 in 5.
And you could say, right, 2018 had two of them because you had Volmageddon,
right?
And you had Q4, and that's really like to me in my career, Q4 2018 sentiment was like COVID was, you can throw COVID in there, but it was
so fast.
And it was so abnormal. Like there was no one in the world that knew what was going on.
Right. And people had outside noise levels that were at the time appropriately correct, meaning like you're concerned about your teammates, you're concerned about your school, you're concerned about your family, rightfully so, your priorities. Whereas now, like, are tariffs going to physically hurt you? Like, are they physically going to cause death? Not likely, which is a little different than a pandemic that the initial phases of. Now we could go on a whole 3-episode journey of COVID and what it really was, but pandemically speaking, where you're legitimately looking at reprioritizing your life and recognizing health and life are at stake, which is a little different than now, which is pocketbook, right? You're looking at pocketbook and you're looking at your account and tariffs and all the other noise that goes with it. But the signs are there that we're close, whether it's the noise, sentiment, internal client sentiment, family sentiment, because, some of these things that we highlighted before. Now, every great bear market starts from this type of scenario as well. So I don't want to sit here and say 6 to 12 months from now, we can't be lower. And it's why we use our processes. It's why we use that 5-day and 200-day to guide risk management. If we
bounce and rally here for a couple weeks, it's going to fade. But we can rally to 6,000 and not fix anything.
Right. You could still be range bound. I mean, even if we were to talk in range bound terms, we have a 0% return since September of 2024 in something like S&P 500. S&P hasn't gone anywhere in return terms. And that was after a really nice period of time. And you could, like you said, you could rise 6%, you could get back up into 6,000 and still be range bound. Don't know. You have to have a process and a plan. And again, as the client letter highlights, having a plan, having a process is way more important than having a prediction. I cannot tell you where the market's going to be 6 months from now. For whatever reason, investors like that type of thing where, that I suppose it goes back to that bias of you go to the doctor and you want to be told everything's okay.
I got to admit, I lost too much money doing that.
Right.
So I'd rather just have like a risk reward line in the sand and say, hey, if we're below this, I don't really feel comfortable owning stocks, but if we're above this, I'm cool.
Right.
And you got to find, like, everyone's got to draw their own line for what fits you. But yeah, there can't be and you could be wrong, right? And the whole point of that is you all, like, one, I think at least for me personally, it brings a lot of peace of mind. Like I can, and I do that. I will write Post-it notes. And it's just a reminder that if you're below this or above, right, it works both ways. If you are above some level, a predetermined level, I would say don't make these decisions like in the moment. Have some type of predetermined level where you're like, okay, if we're below this, and it could be incremental, right? Like it doesn't have to be this, I go from 100% exposed to 0. And you don't have to worry about the headlines. It's just, if we're here, I want to be involved. If not, I cannot tell you how much. I mean, I am bald and I have a lot of gray hairs. But I'm willing to bet it would be even worse if I was still, just trying to figure out, I don't know, what are you going to do? Buy stocks when there's a ceasefire in Ukraine? What's the end goal here?
Right.
Or when the bird flu's over, you're going to buy, I don't know how you use that to buy.
Well, it doesn't tell you when you're wrong.
No.
Right? If you blindly buy because, the president delayed tariffs, or there's a ceasefire in Ukraine, or like, all those examples that you gave, how do you know when that thesis of buying is wrong? Because stocks could keep declining after that, because guess what? The market knows more than you or me or anybody listening, which is a hard truth. People don't like to hear that. People like to often say, oh, I think the market has this wrong.
It doesn't. Trust me, it does not have it wrong.
No. So it makes sense to have a plan in preparation for outcomes. If I can use that example again, if a linebacker steps in the A gap before the ball is snapped and I just ignore it and I just predetermine, make a prediction.
He's not blitzing.
He's not blitzing.
I ain't worried about it.
Or he absolutely is. You can't live in absolutes. Like he's absolutely coming or he's absolutely faking. No, it's what do I do if he comes? What do I do if he doesn't? And paying attention to the other players on the field and having a plan for that, right? Because if I signal to my tight end, Phil, when you go out on your route, if you see that blitz coming, you fill that spot. That's one way to beat it. You just have to have a plan. And for us, it's pretty simple. We've taken our foot off the accelerator. Our clients are aware that we're holding higher levels of cash. Are we fully out? No. Now, I can tell you that the support of this podcast, the Adaptive Select ETF has a tool within it. And it's worth highlighting that ADPV is listed on the New York Stock Exchange. It helps investors access two of the most prevalent factors in markets, momentum and relative strength. It uses proprietary identification methods, which allows Adaptive Select to attempt to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. And I know in that particular strategy, there is a method. It's going to own stocks, but when a certain environmental indicator is there, such as a 5-day and a 200-day, one closing below the other on a Friday, it moves to cash and T-bills. You can have those.
The downside.
Right. So it's about having a plan. And here we are, 6-7% off the highs. We're within normal parameters of an uptrend, perfectly normal. We see this each year. We're heading into a seasonal period where a bottom typically happens in March. Does that happen? If it doesn't, that's information. If we close March at the end lower than where we are right now, that's really information to pay attention to. And time will tell. And there is no prediction about where the market's going to be 6 to 18 months from now.
Agreed.
But if we're back above a 200-day, that's proof that buyers still have control of this bull market. And that's really what you have to be asking yourself. So what else do you want to touch base on before we wrap it up?
So with all the weakness in equities, there are some things that begin to perk their head, right? We kind of, even with gold not moving that much, now its relative chart has started to move through some important levels.
Right. The highlight.
I think that Bitcoin has had some interesting behavior. Certainly one of the bigger, should we be risk on? Should we be risk off kind of out there? Really struggling at 91,000, which is, it's such a great asset because there's no fun. I guess if we had invited some Bitcoin maxi on, he could probably tell us. But it's such a pure asset in regards to able to follow it for price. Like there's no earnings reports. It trades 24/7, but really struggling. Now, it is above a rising 200-day, but tough. 91,000, I think that's a fair level to use if you wanted to be on the flip side. Now, again, maybe harder with an upward sloping 200-day, but, and all the positive news coming out around Bitcoin, or what's been touted as positive news, I think that they sign an executive order to start a crypto fund. And do you see Bitcoin take a break here? Just with all the big news around that. Kind of seems so.
Yeah. And I think it's interesting when that news comes out, how often that's the end of the rally. And I think you've got a trade weighted dollar back within a range, back below 104, 105. I think that's extremely important. You mentioned gold above important relative levels. And so you have these dynamics at play. And then when we talked about August, September, and October of 2023, it was down with US stocks, international stocks. And we're not seeing that here. So is this a rotation in international stocks? We do really have to be paying more attention to what's going on with foreign and world stocks. I think that's definitely on the table, that we could get pretty US myopic, focusing just at the US when you have some strength showing up overseas. And that doesn't really fit the narrative either, right? You've got a pro-America president touting tariffs. You would think, right? Your natural inclination would be like, oh, that's got to be negative for international stocks. Well, here we are, and international stocks are doing better to start the year than US stocks. Okay, let's sit up and pay attention to that.
For sure. I really like that. That's a great point.
Don't marry the narratives. Marry your wife and price, and you'll be all right.
Correct.
So we reached the end of our time. Ian, I appreciate you being on here. I know you and Kevin are going to do your best to cover while I'm gone on a trip. And if anybody listening is going to be at Future Proof down on the 18th and 19th, please reach out to me. I'd love to connect. But otherwise, I appreciate you and Kevin covering for me. Ian, much appreciated.
Yeah. Have a great weekend, everyone.